Yes, you are listening to the Ready, Set, Retire radio podcast with Steve Anzoni. My name is Jessica Forkel. I'll get more details on the website at fairwayfinancial.net.
So they are not as high as they were last year. So the question becomes, do I still buy an annuity in 2025? Well, what are some instances, Steve, where an annuity may be a good choice as far as guaranteed income?
Well, that's a great question, and there are several types of annuities. There's the fixed interest annuity that has a particular term, whether it's 2 years, 3 years, 5 years. And those are the ones that act more like a traditional CD. So you buy a 5-year annuity, it might have a 5% fixed rate for those 5 years. So those are pretty straightforward. Of course, when the term ends, you're left with what's available at that time. And then there are guaranteed income annuities, which you put in a set amount. And a lot of these companies, Jess, they'll roll it up. They call it a roll-up rate. So meaning that the money will grow at that set rate. And many of them are in the 8.25 to 10% a year range. Okay? Now, I know what you're thinking out there. How can they do that? That's impossible. Well, let me tell you how they do it, okay? It's a roll-up rate because it rolls the money up for future cash flow and income needs. It's not a roll-up rate where someone can walk away with that lump sum pile. These products are designed for lifetime income, similar to the old pensions that people used to have, right? So as they roll up, depending on your age, they have what is called a payout factor. And some of those payout factors I've seen is still as high as 7.5% guaranteed for life, Jess. So these products are still super competitive for people who are looking for guaranteed cash flow, especially if you're married and you want both of yous to have that same check, okay, and not have it, say, drop off to half, like, for example, Social Security, of course. If you're married and a spouse dies, you lose one of the checks. Now, fortunately, you lose the lower of the two checks, so that eases the pain a little bit. But in this case, the check remains at the high level. So it's really super, super competitive still. And again, everything's relevant, right? So if interest rates drop in the banks and they drop on regular fixed interest annuities, it's still all going to be relative to what's going on in the economy. And so remember, 4 years ago, if you got 2%, you were doing handstands. And today that would not be acceptable, but it's all relative. Today, 4, 4.25, 4.5 is still pretty competitive for a safe, guaranteed product, Jess. So yeah, people should consider annuities in a variety of settings for those people who are conservative by nature and for those people who are concerned about lifetime cash flow so that they don't run out of money. Those are the people who should be looking at these, and they still are. In fact, they're very high demand. We've gotten a lot of calls on these from obviously the radio show, Jess, and of course from the live events that I do. We still have great attendance. People are still curious about them. So yeah, they're very much in play. And again, if it's the right fit, you should definitely consider them, even though interest rates may have dropped off. And by the way, they haven't dropped off that much, Jess. I mean, maybe a 0.5% so far.
Yeah, not too big.
And it really fooled me. I thought that interest rates were going to go down a little bit quicker. So I'm kind of pleasantly surprised that they've hung in there as long as they have. So take advantage of it.
I was just going to say, I think the easiest thing for folks to do is, if guaranteed income has been on your mind or you've heard of it or you want it to be a part of your income plan, this is a conversation to have. There's different types of ways to gain this guaranteed income, annuities obviously being, obviously one of the most popular ones. And when it comes to interest rates, guys, you've heard the saying before about, you refi your home when interest rates are low, you refi your retirement when interest rates are high. Interest rates have gone down just a little bit, but not that much to where you can't can't capitalize on those high interest rates. I think that is important to remind our listeners about.
Got to just jump in and say, look, it should be part of an overall plan, right? You shouldn't have all your eggs in one basket. And if you're still working, most of us by default do, right? And it's called the 401k or the 403b. But if you're in a position where you're maxing out that 401k, then this might be an opportunity to look for safe alternatives to the market, especially we just talked about what happened earlier this week with the AI world. And really, that's just common sense, in my opinion, to not, put it all in one basket and to have pieces somewhere in case, things happen. Inflation rears up again, or inflation goes flat, or the market goes flat. So you don't want to have all your eggs in one basket. That's all. Simple as that. If that makes sense to you, and if you're concerned about having too much in one basket, then give me a call and let's talk about alternatives to what you've been doing traditionally, or even to look at a cash flow, a guaranteed lifetime income plan, because maybe you haven't explored that. And I'll tell you, the interest rates are still amazing there. So if you're at all curious, give us a call at 508-552-3230. That's 508-552-3230. Or you can visit us on the website at fairwayfinancial.net and say, hey, Steve, listen to the show, love the show, and I'd love to talk about some alternatives. I just want to get some information, and I would be happy to share it with you.
I ran across an interesting article. It was actually on Yahoo Life, and it addressed condiments that can make you sick if they're used past your expiration date. Steve, I got to ask you, how many times do you head to the fridge to grab whatever it is, salad dressing, whatever, and you go, oh, man.
I just laugh because I think of that commercial with
expired.
We have ants. Yeah, expired.
Yeah, same.
Kind of like describes my mother's refrigerator sometimes. I get nervous. I mean, I love her to death. She'll be 89 in a couple of weeks, Jess.
Oh my gosh! Well, good for her.
Yeah. So fortunately, my sister lives close by. I'm about an hour and 15 minutes south, but we try to get up there and see her and make sure that things aren't expired.
I was just going to say, check the refrigerator when you go check on Mom, because, things like mayonnaise, they contain raw eggs. You got creamy salad dressing. That goes bad if it's, opened and left out too long. And then things like pickles and brine. You got to be careful if it's cloudy in there, right? You don't want to do that.
I would never have thought of pickles because I figure they're already pickled. They're not going to...
Same. I thought they would last forever.
And like
apparently
sour
not.
cream. Sour cream's already sour. Does that expire? And the answer is yes. Apparently
yes, it
does.
So. Yeah, well, you tell me. We'll get you one that's 2 months expired. Take a bite and let me know.
No, thank you.
Well, speaking of expired food, you having to check those expirations. It got me thinking about, some retirement strategies that are expired, because we talk about it all the time, how it's not your grandfather's retirement anymore, Steve.
I'm sitting there going, all right, we're talking about condiments. What does this have to do with what I do? I just knew that you were going to flip the switch and figure out how to tie this in.
That's
so that's why, I have you here, Jess. I'm very fortunate, and there you go. So, I mean, it's funny, but yeah, there are a lot of strategies that are outdated. I mean, really, like, for example, the 4% rule that's been around for more than 30 years. It basically says, hey, if you take 4% of your investment portfolio, you should be okay. And I always comment on that and say, yeah, well, I don't want to maybe, should be, could be okay in retirement. I want to be okay. You know what I mean? And then the other part is saving a fixed percentage of income. I mean, my clients are so used to saving, right? I guess it's that generation. But when you get into retirement, it's a different world. It's not about the saving strategy as it is about, the spending strategy and making sure that you do not run out of money, because that is the number one concern amongst people coming in to see me, is they don't want to run out of money. And that's the number one challenge I have, and we always talk about that first up. And so those are just some ideas and some things that are, I don't know, I guess old school and not really as applicable today as it was. I mean, look, this whole I need to be out of debt when I retire. Well, let me tell you something. It helps. It's always going to help you. The less debt you have, the less money you need to retire. I mean, I don't mean to sound like Captain Obvious, but It's very true. If you can get out of the bad debt, the credit card debt, stuff like that, if you can get your mortgage paid off, that would be a huge help. Of course, you'll still have the real estate taxes, but anything that you can do to lessen the need, if you will, for cash flow to pay for debt will help you immensely go far.
Sure.
And I know people say, I want to pay off my car, but a car's going to reappear. Okay, no matter, if you're retired or working, you're going to need a car. Eventually, cars are going to go. I mean, it's just the way it is. So I don't really count those as much as I do credit card debt, which can be, I'm shocked that I see credit cards today at it's still 18, 24. Some of these store cards, like they give you this deal, hey, 6 months at zero. And if you're not paying attention, after the term is up, it jumps to 24. And it goes back to day one. You got to be really careful on that. And let's just make sure that you're on track and that we can provide enough cash flow and income so that when you do retire, you can stay retired.
Get more details on the website fairwayfinancial.net. That's fairwayfinancial.net.
Steve Anzoni is a licensed insurance provider by the Division of Insurance and is not registered as an investment advisor. Insurance and annuities offered through Steve Anzoni, Massachusetts Insurance License 3851053. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company. Read your contract for restrictions, limitations, or penalties. Steve Anzoni is not licensed in all 50 states. To find out if Steve Anzoni is licensed in your state, please call 508-398-3337.